Welcome back. We are diving deep into NXP Semiconductors, ticker NXPI, specifically unpacking their Q3 2025 earnings call.
Yeah, and this one felt pretty significant.
Right. Not just the numbers, but it marked a big leadership transition. We have the incoming CEO, Rafael Sotomayor, taking over from Kurt Sievers.
And what a time to step in. Management, well, they sounded really optimistic, didn't they? Painting this picture of sequential improvement, sort of signaling a cyclical recovery might be starting.
Definitely. But then you look at the market reaction. The stock closed down almost 4% on the day of the call.
Exactly. That's the puzzle, isn't it? This big disconnect between what management was saying and how the stock traded. That's really what we need to dig into for you today.
Okay, so let's start with the basics, the actual results. Did they, miss the mark?
Not really, no. The Q3 financials look pretty solid on the surface.
Revenue came in at $3.17 billion. That was actually a slight beat against the $3.16 billion consensus.
Right. No, granted, that's still down 2% compared to last year.
But sequentially, quarter over quarter, it was up 8%. That's a decent jump, shows momentum.
It does. And non-GAAP EPS was $3.11, bang on consensus. Profitability held up too. Non-GAAP gross margin stayed flat at 57.0%.
So purely looking at those numbers, you'd think, okay, they did what they said they'd do.
Precisely. They executed.
So why the nearly 4% drop then? It suggests the market wasn't really focused on Q3 performance.
I think you're right. They were looking ahead, maybe wanting clearer signs of a strong cyclical breakout, or perhaps a faster ramp in margins than management was willing to commit to yet.
Yeah, that makes sense. The immediate conviction was maybe lacking for the street.
But, the underlying data does seem to support management's optimism, even if it's a softer start. The big qualitative theme was that sequential improvement.
Everywhere.
Pretty much. They said across all regions and all end markets. Operationally, you could see the beginnings of maybe a soft upcycle starting to form.
And you definitely saw bits of that recovery in the specific business segments. Mobile, for instance.
Oh yeah, mobile had a massive quarter.
$430 million in revenue. That's up 30% from Q2.
30%. And that was driven by things like mobile wallet, custom analog parts for a big tier 1 customer, the sticky high value stuff.
For premium products, they actually called it a record quarter for mobile.
Which is fascinating because it shows how strength in some core areas can offset weakness elsewhere. Look at automotive.
Their biggest segment. How did that do?
Pretty robust, actually. $1.84 billion. Now, that was flat compared to last year.
Okay.
But sequentially, it grew 6%, so still showing resilience. And industrial and IoT was similar, up 6% sequentially as well.
And they pointed to some specific areas there.
Yeah, like early demand picking up in things like smart glasses, energy storage, building automation, niche but potentially high growth spots.
Okay, but there was a weak spot, wasn't there? Communication infrastructure and other.
Definitely. That was the big drag, down 27% year over year. Yeah, that really reflects the broader slowdown in telecom spending, the whole 5G build-out sort of pausing. It shows NXP isn't completely immune, even as they try to pivot more towards the edge.
Okay, so that's the backward look. Let's pivot to the future then, because the Q4 guidance, that was surprisingly strong.
It really was a significant raise compared to what they were signaling just 90 days prior, which was more like flat to slightly up.
So what's the new guide?
Revenue midpoint guided to $3.30 billion. That implies another 4% sequential jump and gets them to 6% growth year over year. That's definitely above what analysts were expecting.
And margins, that's key.
Also guided up. Non-GAAP gross margin midpoint at 57.5%.
Half a point up. So even with, mobile and maybe common for being stronger in the mix, which usually pulls margins down slightly, they see profitability improving.
Right. Which suggests they're finding efficiencies or have some pricing power, maybe. It definitely raises the question about their longer-term margin goals.
Yeah, they're not just relying on volume, are they? They keep talking about structural changes, that hybrid manufacturing strategy.
Exactly. They mentioned that rule of thumb again, every extra billion in annual revenue adds about 100 basis points or 1% to gross margin.
But the structural part is interesting. Those joint ventures, VSMC in Singapore, ESMC in Germany.
They went into a bit more detail there. It's about controlling more of that specialized production, bringing some of the higher cost stuff potentially in-house over time.
To capture margin that currently goes to foundries.
Precisely. And they put a number on it. They expect those JVs to drive a significant 200 basis point improvement to gross margin, but that's further out, beyond 2027.
So it's a clear long-term plan for margin expansion, but maybe not fast enough for the market today.
That seems to be the tension. Okay, let's shift to the macro cycle then. Inventory. This is always the big question in semis.
Right. And it seems like the sticking point for this whole recovery story, distribution inventory.
Held flat in 9 weeks, still below their long-term target, which is around 11 weeks.
So distributors aren't aggressively restocking yet.
Nope. And this is where you can really see the market's skepticism creeping in. Management talked about growing backlogs, more short-cycle orders, even customer escalations because of shortages.
All signs that things are getting tighter.
Exactly. Signals of tightening supply. But then, in the same breath, they explicitly said they are not seeing material customer restocking.
Huh. So customers are ordering what they need right now, maybe a bit frantically, but not building up safety stock.
That seems to be the picture. Particularly in auto tier ones, they described inventory as being below NXP's own manufacturing cycle time. Very cautious working capital management by customers.
I thought it was interesting how the new CEO, Sotomayor, tried to frame the automotive picture. He was really downplaying car production numbers, the SAR.
Yeah, he basically said, look, global car production is stable, maybe around 90 million units a year. That's not what drives our growth.
Was that just, spin? Or is there data behind it?
I think the data largely supports it. The argument is that the content growth per vehicle is the real story.
Meaning more chips per car.
Way more chips. Driven by the shift to software-defined vehicles, their S32 processor family, radar, connectivity, all that tech. That growth opportunity, they argue, completely dwarfs small changes in the overall number of cars built.
So for NXP, even if car volumes stay flat, just getting inventory levels back to normal is the main tailwind.
That's the core thesis. Content growth is the secular driver. Inventory normalization is the cyclical kicker.
And looking ahead to Q1 2026, they gave some guidance on modeling.
They did. They suggested using pre-COVID seasonality is probably reasonable. That implies, a high single-digit percentage drop sequentially from Q4 to Q1.
Assuming no major restocking happens before then.
Right, a cautious outlook, confirming they aren't banking on some speculative inventory build next year.
Okay, staying on strategy, let's quickly touch on the balance sheet and portfolio moves. Capital return.
Pretty disciplined. They returned $310 million to shareholders in Q3, about 61% of free cash flow. And did some more buybacks after the quarter ended, too.
And the debt, they were active there.
Yeah, issued $1.5 billion in new debt to pay off $1.25 billion maturing in 2026.
Net increase in debt.
Slightly. And the interest rate on the new debt was a bit higher than the old debt, so a small near-term headwind for costs, which probably didn't help market sentiment on margins either.
Right. But the portfolio moves seem much more strategic, long-term focused.
Totally agree. This really aligns with their whole intelligent edge systems vision, selling off the legacy MEMS sensor business to STMicro.
For potentially up to $950 million.
Yeah, expected to close first half of 2026. That frees up cash and, just as importantly, management focus for areas with better returns.
And then the acquisitions they closed. Aviva Links and Kinara.
These feel really important for the future. Aviva deepens their play in high-speed networking inside the car, connecting all those sensors, cameras, radar around their S32 brain.
And Kinara, that sounds like AI.
It is. Programmable MPUs, neural processing units. Basically, chips designed specifically for running high-performance, low-power AI, like generative AI, right on the device at the edge, not in the cloud.
So embedding AI into cars, industrial equipment, etc.
That's the goal. They see these being material drivers, but again, further out, 2028 and beyond.
Okay, so we've laid out the facts, the guidance, the strategy, but the market's still skeptical, shown by that stock drop.
Exactly. Which brings us, I think, to our next segment. This is not financial advice.
All right, let's speculate a little. We know the market's hung up on the pace of margin expansion and the lack of immediate widespread restocking.
So if you're NXP, especially with a new CEO wanting to make a mark, what could you do to change the narrative? You need something, well, maybe a bit audacious.
Something beyond just hitting the numbers next quarter.
Right. So here's the outrageous but plausible idea. Think about that MEMS divestiture.
Closing H1 2026, bringing in nearly $1 billion.
Almost $1 billion, non-taxed proceeds. And the new CEO, Sotomayor, is already talking up financial discipline and capital return.
Okay, I see where you're going.
What if, say, in Q1 or Q2 2026, Sotomayor takes a big chunk of that cash?
And does a massive buyback.
A massive open market buyback, like a shock and awe move. Signal absolute confidence. Use that strategically generated cash to aggressively return capital to shareholders.
That would certainly juice the EPS numbers.
Instantly. It could potentially offset concerns about the slightly higher debt costs or the gradual pace of margin improvement shown in the core business. It forces the market to reevaluate based on shareholder returns.
So the trade idea might involve betting on that happening. Maybe some call options timed for early to mid-2026?
Potentially. Again, purely speculative, not advice. But it's a plausible catalyst given the situation: new CEO, big cash influx, skeptical market.
Okay, interesting thought experiment. Let's wrap this up then. We started with this core tension.
Management convinced the soft up cycle is here, pointing to internal metrics, strong Q4 guide.
While the market remains unconvinced, focusing on the lack of visible customer restocking and maybe slower than hoped margin gains.
Yeah. And if management is right, the real story is content growth in areas like automotive dwarfing overall car production numbers.
Then investors need to look beyond just the top line revenue or SAR figures.
Exactly. So the final thought we want to leave you with is this. What specific milestones should you track to actually confirm NXP is winning that software-defined vehicle race?
Is it hitting certain targets with the Kinara AI integration? Is it specific S32 processor adoption rates? Maybe tracking long-term auto order patterns differently.
Finding those proof points for the content growth thesis beyond just the quarterly revenue beat or miss, that feels key to understanding the real NXP story going forward.
Definitely something to think about.
And just to reiterate, our discussion today, especially that trade idea, was purely for informational and entertainment purposes, summarizing the earnings call. It is absolutely not financial advice.
Always do your own research and consult with a qualified financial professional before making any investment decisions.